Hello and welcome to my office hours in partnership with the Loft. This is episode 2, the GameStop menace. I know that everyone has heard and read and talked about GameStop. To summarize, GameStop, a bunch of day traders or traders on Reddit and on Robinhood app did a short squeeze and made some money, but did they really make some money, or did they change how capital markets and trading in Wall Street or London or Tokyo works? We're going to try to find out. Number 1, reflexivity and momentum. They traded on reflexivity, i.e. a phenomenon that amplifies itself the more people talk about it. It's kind of like a virtuous circle up to a point until it becomes a vicious circle. And momentum, right? Trading on momentum. Don't trade against the wave. Is that new? No, that's not. Capital markets, financial traders, hedge funds have done that forever. And so now we have a group of people on social media that are trying to do the same. If you have reflexivity and momentum, number 2, then you have price or value. Stocks are valued because you can discount the cash flows, but now it seems that they are priced, especially with reflexivity and momentum on steroids. And if there's price over value, then are the markets that efficient? Maybe in aggregate, maybe over time, but certainly not in one point in time. Number 3, mimetic theory. That's a philosopher, a French philosopher called René Girard, who taught Peter Thiel, who came up with this theory, right? And it says that there may be 2 persons, or there may be 2 groups, and one person, one group is going to envy the other and is going to copy the other, up to a point where these 2 groups or 2 persons are going to copy one another. And we have mimetic theory here between Bitcoin, Ethereum, and memes and momentum and reflexivity happening in the stock market. Or those people on social media, day trading, trying to mime and copy Wall Street. All right. Number 4. It was a short squeeze, right? Short squeeze is nothing new. There will be short squeeze in the future. Shorts are not bad. They are great. They're very important. They're beneficial to a good market structure, so don't criticize short squeeze. Number 5, gamification and financialization. That's also on steroids. All of a sudden, social media is being used in financial markets. Is that a very good trend? I'm not too sure. Number 6, and last point. They want you on this app. They need you on this app because data, right, is the way to win the war. And hedge funds, large PE funds, professional traders have data way more than you as an individual trader. The eye in the sky, and the eye in the sky always win. It's the house that always wins. Why? Because they have more data, and that's one of the number 1 secrets of the GameStop saga, which is order flow. All these big firms buy order flow, and they know before you what is going to happen. So it's very difficult to trade against them, and you shouldn't. And finally, very quickly, don't use that app that gamifies, that does trading, and that incents poor financial behaviors. Use that app that gets you to financial education and to savings and long-term investments. And if you're an entrepreneur in Fintech, don't build that app. Build that app for good financial behaviors, for good market structures, for optimization in the right way, and for savings and investments in the long term. That's it. Goodbye. And I'm back. The next episode, episode 3, will be available on March 9th. Between now and March 9th, I would love for you to go into the YouTube channel of The Loft and to leave questions for me to answer. I will answer them, all the top questions, all the interesting questions on March 9th. So it's going to be a great episode. So please ask your questions and tune in for episode 3. Goodbye.